Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the investment landscape and how we put those ideas together. It's Friday, January 12th at 2 p.m. in London. One of the biggest stories in recent years has been the rise of the money market fund. Today, an investor in a U.S. dollar money market fund earns a yield of about 5.3%, a full 1% higher than the yield on a 30-year U.S. government bond, and almost 4% higher than the yield on the S&P 500. All investment strategy at the moment, to some extent, flows from the starting point that holding cash pays pretty well. Unsurprisingly, those high yields in money market funds for little volatility have been popular. Per data from the Investment Company Institute, U.S. money market fund assets now stand at about $6 trillion, over $1 trillion higher than a year ago, with flows into these funds accelerating over the last few months. But we think this could change looking into 2024. The catalyst will be greater confidence that the Federal Reserve has not just stopped raising interest rates, but will start to cut them. If short-term rates are set to fall, the outlook for holders of a money market fund changes. Suddenly, they may want to lock in those high current yields. Morgan Stanley expects the declines in what these money market funds may earn to be significant. We see the Fed reducing rates by 100 basis points in 2024 and another 200 basis points in 2025, leading short-term rates to be a full 3% lower than current levels over the next 2 years. In Europe, rates on money market funds may fall 2% over the same period. While lower short-term interest rates can make holding money market funds less attractive, they make holding bonds more attractive. Looking back over the last 40 years, the end of Federal Reserve rate increases, as well as the start of interest rate cuts, has often driven higher returns for high-quality bonds. But would a shift out of money market funds into bonds make sense for household allocations? We think so. Looking at data from the Federal Reserve back to the 1950s, we see that household allocation to bonds remain relatively low, while exposures to the stock market remain historically high. And this is a reason why we think any flows out of money market funds are more likely to go into bonds than stocks. Stock market exposure is already high, and stocks represent a much more volatile asset than bonds relative to holding cash. While the U.S. money market funds saw $1 trillion of inflows into 2024, flows into investment grade and high yield saw almost nothing. That is starting to change. With the Fed done raising rates, we expect higher flows into credit, especially in 1 to 5 year investment grade bonds, the part of the credit market that could be the easiest first step for investors coming out of cash and looking for something to move into. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.